The number one question we get asked is, what is the interest rate, or what is the lowest interest rate I can get? Right, because everybody is conscientious about the price that they pay, okay? So what we're gonna do today is we're actually gonna give you the inside scoop. We're gonna actually show you what the mortgage professional is looking at when they're determining your offer, okay? Now, a lot of your offer is dependent on your personal financial situation, right? So how much you're financing, what your credit score is like, how much money you have available. So a lot of that will dictate your offer, okay? So in this particular example, we're gonna do a $500,000 purchase price with 5% down. So you'd be financing $475,000. You have great credit, 765 or better. Typical debt ratio 30%. Somewhere Texas, I put South Lake here because that's where our office is located. Conventional, 30-year fixed rate, and we're gonna push the button. We got queued up a 6.5% interest rate, okay? Now, the first thing that I wanna address right now is that there is no such thing as the lowest rate. There's only a company willing to do a loan with a cheaper profit margin, okay? So companies get to decide how much revenue they want to make per loan. As long as it's consistent, then it's fair. As long as it's the same offer that they offer every consumer with those parameters, it's a fair offer. But you have to be competitive, right? Because there's lots of different mortgage companies. So some companies you will see with very, very low interest rates. It doesn't mean that they have low rates. It means that they chose to do that loan cheaper than their competitors. Well, why would somebody choose to do that? Well, they can do it because what they pay the humans to do the job is a lot lower, which in some ways is a great business decision. But in other ways, it can negatively impact you as a consumer. When you're dealing with such a large financial transaction and you have somebody that may not be as qualified handling the transaction, lots of mistakes can be made. One of which is they may not have the acumen or the knowledge base to offer you different products that can actually save you thousands and thousands of dollars in the next 2 to 3 years. They may not even bring them up just because they don't know how. It doesn't make them bad people. It just means that they don't have the knowledge base to do it or the experience. If somebody's really good at something or somebody has a lot of experience, typically they want a higher compensation for that. So that's one of the reasons why you need to ask yourself, and more importantly, maybe ask the person you're doing business with, do you own a home? Because if they're not a homeowner, then maybe it's kind of hard for them to advise you on the best practices if they themselves have never been through this process. So something to ask. Another reason why who you do business with is a big deal is because you may not even get under contract depending on how communicative the representative is. So for example, if the agent representing the seller, you want to buy that home, calls on Saturday at 7 p.m. and the lender doesn't pick up, chances are they're moving on to the next offer. They're not going to wait until Monday morning to hear from Chase Bank, because I guarantee you there is a local lender right around the corner in that market that is going to answer the phone because they've provided their cell phone number, and they're going to talk to that agent, tell them how great the client is, and that person's going to win the contract on the home that you wanted. So that's something else that you give up, is that you can't do business with a low-cost provider and expect them to be available 24/7. It's just not possible. There's also logistical issues. For example, if you don't close on time and you've set up water, gas, electric, movers, you have all these plans to move your family. Maybe you even have travel plans, right? From one state to another, and the lender doesn't deliver and they don't close on time, this can cost you thousands of dollars. This could be the time that you lose just to reschedule everything is sometimes not worth a slightly lower interest rate. So these are things that you need to ask yourself, and you need to talk to the company about. Do they have a closing guarantee? Is it in writing? What happens if they don't close on time? Is there any financial repercussion? And typically the answer is no, there's not. So when we look at this chart, the first thing I want you to notice is that when we put in the product, notice that there's lots of different names, okay? Because there's lots of different banks out there that can basically finance your home. The other thing is you see that there's difference between Freddie Mac and Fannie Mae. Well, why? Well, Freddie Mac and Fannie Mae have different guidelines, different ways that they would qualify you for a loan. Sometimes it's easier to use Freddie Mac, sometimes it's easier to use Fannie Mae. Then you come into interest rate and price. And notice that in this particular example, Fannie Mae is actually more expensive than Freddie Mac. So if you're using somebody that maybe hasn't been in the business that long, they may make a simple mistake by picking the wrong product. A product that could cost you, from what it looks like, about $1,100 or so difference, which is a big deal. Like, who wants to pay more for something when you don't have to? So we click on this product here, and you notice that there's not just one interest rate, which when you're a consumer and you talk to somebody, it sounds like there's only one rate, and they give you this rate and they give you this offer, and that's what you accept or reject. But that's not true. We like to show our clients this entire rate chart, and we say there's actually more than one interest rate. But the correlation on this chart is the lower the rate, the more expensive it becomes, okay? And then we have to put it into a financial tool that we have to determine, is it a good decision or a bad decision? So when you're dealing with these low-cost providers that have very low interest rates, they may not be able to put it into these tools, or they may not even know how to use them to be able to tell you if it's a good idea or a bad idea. They may also not make you aware of kind of what's going on in the market when you're estimated to refinance next, and there definitely is not going to be any incentive for you to refinance with them the next time. So we like to show our clients this chart. We like to go through it. It's a bond chart, so in bond terms, anything that you see that's at par, okay, for example, par is 100.000. Anything above par is going to be a rebate or money back to the consumer. Anything below par, right here, is going to be a cost. So notice that the relationship between lower rates and fees is that the lower the rate, the higher the fees, okay? So typically this kind of 6.5 is really close to where some people would probably select or offer, maybe even 6.624%, costing 1 percentage point or a little bit under 1%. So if you did business with us, this is kind of the process that we would go through. The last thing you need to notice on this chart is that the longer that you lock in an interest rate, the more expensive it becomes. So this one's assuming that you lock it for 30 days and that you're going to close on your contract within 30 days. But let's say you want to lock today's rate for a longer period of time, 45 days. You'll notice that it gets more expensive. Even 60 days, it's going to get more expensive. We have a product that's really cool. It's called Lock and Shop. It would actually let you lock today's interest rate without even having a property. Most companies won't even think about that. So it'll give you a total of 90 days to basically lock in that interest rate and identify a property to purchase. But you gotta identify and close on the property within those 90 days. After 90 days, we kind of got to start the process all over, and you're subject to current market rates. But overall, it's a great product. So when considering who you're doing business with, ask some of these questions. This video is purely informative. We just want you to be an educated consumer. But if you have more questions or you would like a quote from us, obviously feel free to reach out.